Well, good afternoon and welcome to the show. How are you doing today?
No, very good. Thank you so much for having me. I'm really excited.
And I say afternoon, but I never know sometimes where I'm talking to the person or the guest at. I mean, we've been all over the world speaking on these podcasts. So, where are you located at?
I'm actually outside of Philadelphia, so yeah.
Outside. So, we're all on the Eastern train here. We can find to raise our state of mind is to do something we love. And something that you love and passionate about has to do with taxes. Tell us a little bit about that.
Yes, so I started, my first love was actually playing golf. So
Oh,
I
cool.
played golf growing up all through high school, college, and a year professionally. But I feel like it gave me a really good picture into life, right? So, like, most 20-year-olds weren't hanging out with a bunch of old people on the driving range, and I
Mhm.
was, right? So, kind of sort of really got to understand, your entrepreneur, but also how people had been really successful in life and were able to, retire really well because where my coach was happened to be like a really nice country club. So I got to kind of see firsthand, even though that wasn't, my reality with my parents, it really was interesting to see these people in their 60s and 70s just really happy and, for the most part, enjoying life. So, fast forward, I ended up not playing golf. I ended up going back for my master's in accounting. I became a CPA, started working at a big firm in Boston, outside of Boston. And what I realized is that my background was just very different from most accountants because most accountants hadn't had these years of spending time with people much older, much more
Mhm.
established than me, and sort of being that, fly on the wall. And so when I started to look at tax returns, I thought, what's really, broken or an opportunity is that if you have the busy season approach, you never get to have a conversation with your client, right? You're just getting the return done. You're up against a deadline. It's rush, rush, rush. And where we as accountants can be most valuable is looking beyond just this year, but really, what are you trying to do, right? What is your goal? What are you, strategy? And do you even understand, how you're being taxed? And a lot of times, no. And so what, I've really tried to do for the last, 15 years out on my own is really build a process to where we can engage with people throughout the year and really work on educating them first on taxes, right? Because most people really don't understand this whole convoluted system called
Mhm.
taxes. But then ultimately, how can you strategize to make sure that you are, building the life that you want to have when we get to retirement? So, especially over the last 5 years, we've actually gotten much more involved in real estate. We were always involved in real estate because most of our clients are either business owners, entrepreneurs, or higher net worth, who probably own some real estate. But what I've seen, sort of in the wake of the pandemic is the idea of, inflation has become the reality. So our old way of thinking about long-term planning and long-term tax strategy, really has seen that there's much bigger benefit than there ever has been of really diversifying into real estate to be able to both control how much I'm paying in taxes every year and really make sure that I'm building wealth in a way that's hedged against inflation. It's more understanding the nuances of the rules, right? I think first understanding, you know, your goal of real estate, is it really helping you on a tax return or is it not? That passive versus active rules. And I think the key is, I was joking with my clients of like turn off the social media, right? Like it's not one size fits all when it comes to tax strategy, that it really starts with understanding your specific picture, your job, your primary profession, your property that you currently own, and then making sure that you structure it in a way that you meet those goals, right? That you hit, whether it's, effective tax rate, lowering effective tax rate, or just understanding tax and really more scaled to building long-term wealth, that's really where it starts. Is just, understanding that. But I would say, I think one of the biggest challenges as the world has changed over the last 10 years is, taxes have definitely gone up. I think that's one of the biggest realities, especially if you're living in one of the northern states or western
Mhm.
states. You're looking at people who are, mid 40s as an effective tax rate once you factor in that state tax, and that's a huge chunk of, you go to work every day, and
And half of it you don't bring home.
right. And so, I think it's a reality we have to face, because taxes haven't gone up for everybody, but they have gone up for the higher net worth people. And that's okay. It's what it is. It's not saying that we don't want to pay into the government, but we just have to be aware of your reality, because that's where the biggest thing that I've seen over the last 5 years, especially, is just that you're bringing less home, right? Like, the states are enacting more tax, the cities have tax, Massachusetts has a wealth, like, there's crazy taxes that did not exist 5 to 10 years ago. So if we're still in the same planning mode that we were in 5 or 10 years ago, that's probably not what's going to serve us today, because we're fighting this losing battle in this mid-40s effective tax rate. I think even if you can't control that piece, at least being honest about what that percentage is.
Yep.
Because at least then it's not a surprise at the end of the year, because now you can actually plan for it, and you can now look at your, if you're a high net worth W-2 earner, like, look at your withholdings. Like, then we're not in this world of, like, we feel reactive. We just, it is what it is, like if I choose to live in New York City and I'm a higher income earner, I'm probably in the mid-40s by the time I understand my city tax. But let's understand our city tax, so that way we're not stressed. We're not, it's a decision, it's a choice, and it's a great choice. New York City is awesome. But, like, I think too many times we just hide away from these other taxes, especially the state and city, and, don't realize that that's what you're actually paying. That it's not about what you're writing the check for at the end of the year. This is what you've actually paid in real dollars. And I think where that's important is there are things you could do, whether it's, be actively involved in a business, or, actively involved in a, short-term rental potentially. Like, there's things you could do to lower that tax rate. But, and they're, legal. It's not, avoiding taxes, but it's just giving you the knowledge of, this is that next step of, here's what I could do to get my tax rate down 5%, potentially. And if at my income level, that could be a big number. The idea that it's a set it and forget it, that is not the case. Like, it's active for a reason, right? It's active because, in the span of 30 days, you could have 10 people, 10 stays in your property, 15 stays. It's really a nightly rental scenario. But where that's appealing from a tax standpoint is now it's treated as a business, right? To the IRS now, this is really, you are actively participating in a business. This isn't just passive and, something that you have one renter and they change hands every 12 months. But this is really an active business. You're marketing for it. You're, taking new pictures. So it's work. But, I think the other side of that is you are also in control. Because I think what I've seen, especially in the short-term rental, is you now have an investment that you're able to, truly change on a monthly basis, right? Really find your break-even point, grow your revenue. I mean, just like you would another, true operating company. This is your new operating company designed as a house, right? But the other side of that is now the losses are, they're active, they're ordinary income. So, what I've seen is you're able to lower that effective tax rate, 5-10% in some cases, get, some of your withholdings back in that first year, and really build a strategy where you're reinvesting into additional assets, over a 5-year period. And, I think the other piece of that is, even if the property breaks even, from a cash flow standpoint, what's interesting is that mortgage is basically getting paid by your renters, right? So you're basically holding this property that you are getting more equity in every year without any additional money out of pocket. So yes, you had your initial, setup, startup costs, but over a 5 to 10 year period, that's where the magic happens, because now you've really grown this equity to where, your net worth is higher, without really having a lot of out-of-pocket expenses, because you're, breaking even and getting all this revenue on the rental side. But whatever your accounting software, I love the statement of cash flows, because that really does tie back to your bank account. And I think that's the most important part. As an investor, the tax is what it is, and we need to understand that. But I do think as an investor or a business owner, you really need to understand that statement of cash flows to say, be honest, right? If my bank account went down, then this property is not cash flow positive. And that's okay, because it could have gone down because I paid off my note, or I paid down my note, or I made extra principal payments, or I did an improvement, whatever it is. That statement of cash flows will show us that, because it'll show us, in addition to the net income, so I'm showing, 20 grand of net income on a property, but I had, a $15,000 improvement and I paid $15,000 to principal. Well, I did lose 10. That's okay, though, because that was strategic, right? Like, I now have an improvement and I have paid down
strategic as long as you know it.
Right.
Yeah.
Yes.
Otherwise,
but on the flip side, I think what I see a lot is then you have the person who's saying, "Oh, I'm just going to sell," and you're like, "Well, no, don't sell. Like, that doesn't mean it was a bad year. It's just that these are what happened." So I definitely think if you haven't pulled the statement of cash flows, even if it looks bizarre, try to go through it. And what you'll find is it's the truest test to make sure that your accounting is correct. I think it's an education, just like you would if you were going to go to a broker and build out, a retirement strategy. This is the same thing, because like you said, it doesn't really matter if it loses 10 or 20,000 in the first 2 years, as long as I know it's going to get back that in 5 years, right? So that's really where we're looking, is what is that break-even point? Hopefully it's today, but if it's not, what do I need, whether it's the revenue side or just the time side of, the mortgage, to really make sure that I get to break even. But I would say for most, investors, if you're looking at the long game, it really also is about that other piece of, is the goal to maybe pay it off earlier. If I have extra cash, maybe my goal is to pay this off sooner, because the magic happens when I'm retired and this property is paid off, because you've literally then created your own pension plan, because now the rents are hedged against inflation. So again, my happy retired clients are the ones that have real estate, because eggs are more expensive and their property's worth more, right? So they're not mad about that. And so if you have this property that's now paid off, rents going up just means that, yes, it's gotten more expensive, but someone's going to pay me more to be there for whatever length of time. So that's the magic that we're trying to get to. And yes, it's great if it has wins right away, but those wins are the big wins to where you really have complete peace of mind in retirement. What we do with that is really work on 3 key important things with our clients, right? So the first one is understanding your existing tax picture, right? So really looking at it and building out a strategy for the next few years of all of your income sources and what's really going on there. The second piece is through real estate investing, building out these 5-year plans to say, if we had a cash to deploy to 2 properties or 3 properties, where would we be as a whole in 5 years? And, what does that look like from a net worth standpoint? And then ultimately, treating these rentals like they're businesses and building out monthly budgets, because a lot of times they're in seasonal locations. And a lot of times the investors really haven't done budgeting before. And so our team will work with you to set some KPIs for the property to make sure that we're running it efficiently and we're focusing on, the nightly rent that will get me to where I need to be, and, taking some of that stress off, because a lot of times this is your first side of, being a business owner, and, just having those monthly targets can really help it feel less overwhelming. But I think as a whole, what we've seen is, by going through the process, by really giving you back control as the investor, that you now, have a much better picture of where you can be in 5 or 10 years, being in that driver's seat. And I think that's the priceless piece, is now you are driving your own destiny.